So you're all very welcome this afternoon. I really hope you gain a couple of points that you can use straight away in your businesses during this hour and a half. I'm really passionate about financial mastery, so I'm delighted to be here to be sharing with you what I've learned over the years, and I really hope it has an impact, a very positive impact on your business over the coming months and years. So, some of you may have come across me before, so some may know me quite well, and some may have never heard of me at all before. So just to let you know briefly, I've been working as a business coach for the last 15 years. I use mostly my own experience and knowledge. I've worked in many industries, from junior clerical to senior executive management. I've worked in Germany, the UK, Ireland mainly, Dublin, Cork, Galway, and everything from literally scrubbing saucepans to senior executive management and everything else between. I've worked in the financial sector, in discount retailing, in hospitality, in construction, and many others. So I bring all of that along with my qualifications, and I use ActionCOACH methodology. So ActionCOACH is the world's #1 business coaching organization, and I bought their franchise about 15 years ago and have been coaching since then. So what I'll be sharing with you today is a combination of all that experience and knowledge over the years. And as I say, I hope you gain some good insight into finance from it. So look, what I'm going to do, I'll show you first of all just an overview of what we're going to be covering. I suppose first of all, just to say, I know we called it a workshop or a webinar rather than a workshop, but really your participation would be fantastic in this. We will allow time for questions and answers at the end. But I'm saying that if you have any questions as we go along, if you're familiar with using Zoom, you'll know that there's a chat box. If you can't see it in the toolbar at the bottom of your screen at the moment, you might see 3 little dots along there someplace. If you click those, the chat box option will come up. So at any point in time, put a question in there, and I'll go through it then as the questions come up. So what I'm going to do is I suppose we're going to just concentrate kind of on the 4 red areas here. I'm going to look at getting closer to your numbers and what numbers are important for you in your business. An overview of financial documents. I'll try and cover off on some terminologies and some, let's say, what I would consider common errors that can be made. I'm going to highlight the important planning and budgeting, the key performance indicators for your business, the key figures that you need to know. And I'll go through the true cost of discounting and increasing prices. And at this particular time, it's really important that we understand what we're doing when we're changing our prices. And towards the end, then we'd look at, hopefully you'd share what learnings you've got. So please feel free to take as many notes as you possibly can, and we'll do a bit of question and answers. So Elaine will be sending out the slides just to let you know. So you will be getting a copy of these slides, and you will also be getting a recording of the webinar. So if you do miss anything, don't worry about it. You will have an opportunity to go back over it again. So without further ado, so I'm just going to give you a quick overview. As a business coach, these are the different areas that I work in, and I just want to give you an overview of those so that you understand where the finances kick in. So we talk about the 6 steps to massive results. So the first area to work in a business is mastery, and that's bringing a business from chaos to control. The next area we work on is niche. That's really more about marketing, and in particular the figures around marketing and different marketing strategies to increase profitability in a business. And that's so that you can have predictable cash flow at niche level. Then we look at leverage. Leverage is about systemizing your business. So you already have a business model that works. It's been proven at the niche level. And now you look at systemizing that so you make it really efficient and scalable. Then you look and consistent, so you can consistently provide your product or service really well to the marketplace. Then we look at the team. So the system should run the business and the team run the systems. So the team then is really where you get to start working on your business more rather than in it, because you have a great team around you who actually run the business for you. And once you've those 4 steps taken care of, the synergy impact happens. So that means you get greater the results than the sum of the individual parts. and then the results happen automatically. So the most of coaching that we work on focuses on mastery, niche, leverage, and team. The mastery level, we're going to be covering one element of that today. There are 5. So there's time mastery, delivery mastery, money mastery, self-mastery, and destination mastery. But I'm going to be focusing this afternoon on the money mastery element of it. So, okay, so money mastery, so you can have a commercial enterprise. Without that, you know, we can't even think about profitability, or can't even think about a business working without you. So we're just focusing on the commercial enterprise part of it there. So what I want to do is run a quick poll. This is an anonymous poll, so you could please be as honest as you possibly can. It's a few questions around how you feel about different areas of the finances in your business in relation to break even and cash flow in particular. And as I said, please be as honest as you can. It's anonymous anyway, but it's just to give me a bit of a gauge as to where to put the emphasis when I'm going through the workshop this afternoon, and hopefully help give you even more value and targeted value from the session. So I'm just going to launch this poll now. So I would really appreciate, there's 3 questions, and there are 3 options, 3 optional answers for each of them. So if I could ask you to just click on one of the 3 options for each of the 3 questions. You might need to scroll down on your view of it to see all 3. So if I could invite everyone to join in on the poll now, that would be great. Okay, excellent. So we have a few coming through now. I'll just give you another 30 seconds or so for the next few to put in theirs. Excellent, that's great. Thanks for your participation, appreciate it. There's just another few left now, so I'll give them another few seconds to have time to go down through. There's a bit of reading in each of them, obviously, so it takes a little bit longer to do this poll. That is super, we are nearly there. I'm just going to end the poll now in a minute. Okay, excellent, that's super. We got absolutely everyone in, so really appreciate that. So I'm just going to share the results. As I say, they're anonymous anyway. So just to go down through those, so I've asked people, how would you rate your confidence level in making profit in 2020? So 30% said not sure until the accountant gives them the figures, which is what we hear a lot from businesses. We have 50% saying we're tracking and measuring regularly and we're hopeful, which is super, well done on that. And then we have a sales plan, and if we execute it, we will be profitable. So that's super to hear. That's a further 20%, which is great. Well done on that. So the second then, how would you rate your confidence level in reaching break even in the business within the next 3 months? So 1, not sure of break even point. So I'll be spending a nice bit of time on that this afternoon. So hopefully you'll have great clarity on how you can calculate that for you in your business at the end of this. So I know now that I do need to spend time on that because there's 70% there. There's enough business, so we should be okay. Okay, that's great with 10%, and then we have further 20%. We know and measure our cost base and salaries and know exactly what we need to sell each week to reach break even. So that's super, well done for that 20% there. And so how would you rate your confidence in keeping the business cash positive? So we have 30% say that they're dependent on government supports and grants. And again, like, I'm not surprised to see that. Obviously, our environment, the economy has changed massively over the last number of months. So not one bit surprised at all to see that. Next one is we track our cash every week, but we will need help and support to get through this. Okay, again, not unusual given the circumstances at the moment. And 10% say we track our cash and know exactly what we need to sell to stay positive, to have positive cash flow. We have a 3-month rolling cash flow forecast. Okay, and we had a 0% there. Okay, so it's not the share on that. So that's great to do. That gives me a good idea of where we're at on the call this afternoon. So I suppose ask yourself, I'm going to ask you a few questions, and I suppose just to ask for yourself, do you know this for your own business? What is your revenue goal by month? since. So I'm not told, some of you may have had a cash flow or a budget done out pre-COVID, but do you know now, have you re-looked at that figure, and do you have a monthly target for the rest of the year and going into 2021? What is your monthly profit goal for the rest of 2020 and going into 2021? Are you able to answer those questions? And in relation to margin, have you calculated the margin in your business? So I'll go through examples of all this later, but just as an overview, I suppose there's one thing I would like to say about margin. If any of you are in retail, I come across it a lot in retail, not so much in other sectors, but sometimes people use the term markup as opposed to margin. And just to clarify, they are two very different mathematical formulas to calculate each of those. And unless you're very, very comfortable with maths and very, very comfortable with the terminology, I would avoid using both. And what I would recommend is never talk about markups, because it leads to complications and misunderstandings and whatnot. Only talk about margin. It's the margin, that the margin is based on your sales price. Your markup is based on the price you buy the product in for, which is really irrelevant when we're talking about profitability in a business. So it's really the margin you want to be talking about, and avoid talking about markup at all. I could go into detail later if it comes up in the questions as to why, and an example of why that can get very confusing. But for now, just focus on margin, please. So just to explain what margin is you take your sales, or we call the income or the revenues or the takings in the business, and you take your total sales. You take away your variable cost, that be your costs of goods sold, and you're left then with your gross profit. So there's two, or your, as it can also be called, gross margin. Now there's a big difference between the gross and the net, so it's important as well that when you are talking about margin, that you clarify whether it is gross or net that you're referring to. So the gross, either profit or margin, whichever terminology you want to use, is your sales figure minus your variable costs. And then when you take away your fixed costs, which would be your overheads, which I'll explain more in a few minutes, that's what gives you your net profit or your net margin. And only at that point can you tell whether you're actually making money in the business or not. Way too often people judge how the business is going based on gross profit, but they haven't taken into account their fixed costs yet. And then very often they get a big surprise from the accountant when the year is over. And it shouldn't be like that. You should have a good handle of your figures as you go through the year, so that you can make good decisions based on it going forward. So I just want to do a quick overview of the different terminologies of the different types of reporting and explain them briefly to you. So one is the profit and loss. So everybody in business, whether you're a sole trader or whether you're a limited company, you'll all have a profit and loss at least at the end of the year, or well, it could be 10 months after the fact, when your accountant is doing your accounts. And your profit and loss, if it's done on an annual basis, will show the money that came in and went out of the business during that period of time. So it'll be over a 12-month period. Now, some of you will have a financial controller in your business, or you might have software that you're managing really, really well, and you might have a monthly profit and loss, which is what we would aim for all businesses, is to have a monthly profit and loss. But at the very least, you all get an annual one anyway. The profit and loss it's historical. It's based on past events, so the month gone by, or the year, or the quarter, whatever period of time you're looking at. It records, as I said, the transactions, the money coming in and going out of the business. It's a key measure for your gross profit and your net profit, which are key performance indicators in relation to finance in your business. It's calculated historically. And the reason people would do it, I suppose, from an accounting perspective, is to see what profit did the business make, and it's your accountant's job then to make sure that you're complying with the laws of the land and paying the taxes that you should on that profit. So that's the purpose of your accounting profit and loss. But the reason we would want you to do a monthly profit and loss is for managing the finances in your business. So the next sheet that you'll hear people talk about is the balance sheet. Now, the balance sheet looks at one particular day, one point in time. So, for example, if your accounting year ends on the 31st of December, then your balance sheet, you'll have already had one if you've your accounts done for 2019, but you'll definitely have one for 2018. And it'll be dated if your year ends, your accounting year ends in December, then it'll be dated the 31st of December 2018, or you may have your 19 one already. I would hope that's where we try and get businesses to get their 19 one as quickly as possible. So when you're looking at that, it's the present, it's looking at one point in day, and that date that it's looking at will be on the top of your sheet. It records the value of your business at that point in time. It's a key measure of your assets and liabilities. It's calculated, as I said, on a set date, and the notional part is that it tells you the equity of the business. So there are two ones that every business has, even if it's very late in the day. Every business has those at some point in time. The budget, unfortunately, a lot of businesses don't do a budget, but the budget would be a minimum of a 12-month prediction of the future of where you feel your business is going to be. So it's a prediction. It measures the gross profit and the net profit should those sales and costs occur as they are predicted in the budget. It's future oriented, and the notional part of it is that it's to set targets for the business. So the cash flow then is the one that I'll probably spend more time on the session today. So every business, I don't worry too much if a business doesn't have a budget if they have cash flow. Because cash flow, I suppose, is more important, I would think, in a business. To know the break even and cash flow is more important than any of the others. Your accountant will do the profit and loss and balance sheet anyway. So depending on where your starting point is, you'll have different priorities. So anybody who's starting kind of at zero or near enough to it, I would say start with cash flow and break even, which I'll be talking about later. And then, as I say, eventually it would be great to be moving on to having monthly profit and loss and balance sheets. But for a lot of businesses, they're a few years away from getting to that level. So just to explain a little bit about the cash flow. So the cash flow looks at where your cash is presently and also in the future. It fluctuates, and I'll go into more detail in the cash flow later, so I'll explain that more then. It fluctuates. So your budget is a fixed document. You set it at one particular point in time for a future period, be it a quarter or 12 months, as I said. But your budget then stays the same, whereas your cash flow is a living, breathing document that you update either weekly or monthly, depending on which type you're doing. But it fluctuates. As you get new information, you change what is on your cash flow. And that's why it's one that I prefer, and I think is the most important if you're starting from scratch. Start with the cash flow. It records the key measures, or the income and outgoing of the business, not only what is coming in and out, but when it's coming in and out. As I said, the calculated part of it fluctuates. It's partly present, partly future, and it looks at when the cash actually arrives into the business. That's just an overview of the different tools. So another one that I just mentioned there, but isn't on that sheet, is calculating your break even. Now, some of you may have had a break even sales calculated, at the beginning of the year. But we're talking about even if you had that, have you recalculated it post-COVID, really is what we're talking about here. Or even if you didn't have it before, now is a great time to start working out your break even. So I'll just go through a little bit of what that means. And I'll go through an example in a minute, so don't worry about all the terminology here. Again, as I said, people will be at very different places. Some people will be very comfortable with this terminology and it'll be no problem to them whatsoever. Other people, it might be relatively new to them and they're not that comfortable with it. Please take it easy on yourself. Go over the video again. No matter what your starting point is, I can guarantee you the more often you go through this, the better you will get at it and the better you will understand it. So don't worry if it takes a while. Just bear with it and expose yourself to this terminology regularly, and it will become second nature to you then. So the break even, the BE, is the revenue required to break even, to pay all your bills basically in the business. FC is what we're calling the fixed costs, and I'll go through what they would be later. But for example, it'll be salaries, it'll be rents, rates, and as I said, I'll go through other examples later. The gross profit margin is how much money you're making at the end of the day, once as a percentage of sales, once you've paid all your bills. So to calculate your gross profit, that's your revenue minus your variable costs, and to calculate that as a percentage of revenue, you take the gross profit, which will be these figures here, and you divide it by your total revenue figure. So the next thing we want to do is we want to calculate the break even with profit. So that's not only that you pay all your bills, but that you actually have a profit at the end of the year as well. And that's then what you would be paying taxes on. So again, you calculate the first bit as normal. Your break even is the revenue you require to break even, the fixed costs, but we're including profit in this one. You take your fixed costs and you add your net profit goal. Again, I'll go through an example in a minute. And you divide that by your gross profit margin. So an example, as I said, I'll give you an example of variable costs or expenses and fixed ones. So the fixed costs and expenses are expenses incurred whether or not you have a sale. So that's on any given day, if you decided to close your doors for whatever reason, if you've staff on salary, they still get paid their salary for that day. You still have to pay your rent and rates. You still have to pay for the electricity that's keeping the fridges going or whatever else. So they're all the things that you're going to have to pay anyway, whether you actually make any sales or not. Your variable costs then are the costs that you incur because you had a sale. So if you were selling a jumper or selling food, it's when you've actually sold the food that's considered then a variable cost, because you've only incurred that cost because you have sold it. Whereas your other expenses like salaries you would have incurred anyway. Okay, so here's an example now of working out your break even with a profit calculated into it. So let's say your net profit goal in your business is €100,000. Okay, so that's what your accountant would be saying to you maybe in Q1 2021, saying to you, okay, look, in your business for 2020, you made 100,000 in net profit, and that your taxes then will be based on a percentage of that. So let's say that was your goal. And let's say your fixed costs in your business, so your rent, your rates, your salaries, your stationery, your marketing, your coach, your accountant, in any of those professional fees, solicitors, whatever it is, it could be bank loans that you're paying back, anything like that goes into fixed costs. And let's say they all add up to 200,000. And then if you add the net profit goal to the fixed cost, that gives you the figure C, which is your total here. Now, then we divide that by the gross profit margin. So remember, we showed you in previous ones how to calculate your profit margin. So in this instance, the profit margin for the business is 40%. Okay, now if you don't know what that is for your business, go back to your most recent accounts and your accountant will have it in there, what your gross profit margin for the year was. Now, obviously it might be different now, you know, so you might need to take different things into consideration, but just to give you a starting point, a figure to play around with and to see what way things would look, I would start with that, start with the figure that you have. So in this example then, to work out the break even in sales that includes a profit margin of 100,000, we take the 300,000, and so that's our figure C here, and we divide it by 0.4. So 0.4 is the decimal representation of this 40% here. So if this, for example, was 25%, then we'd be dividing our 300,000 by 0.25. Okay, so it's just the decimal representation of the percentage there. So that gives, in this example, that gives 750,000. So what that's saying is that this business needs to turn over in the year 750,000 in order to meet all of its financial responsibilities. so pay all of its bills and wages and salaries and all of that, and still come out with 100,000 in net profit. Okay, and then the taxes are based on the net profit. And if you're to divide that by 12, if you're open 12 months of a year, then that would be 62,500 in the month. That on average every month, that's what you need to bring in. Now, if you're a seasonal business, and if you know that you do 50% of your business in 3 months of the year, then you need to change, you know, what you need to bring in your cash flow and have it increased for those 3 months. But if it was flat over 12 months in this example, it would be 62,500. And then if we divide the 750,000 by 50, so that's saying that this business is open 50 weeks of the year. You might be open 52 weeks of the year. You might be open 40 weeks of the year. So again, whatever is relevant for you, you divide it by the relevant figure. And that lets you know per week how much you need to turn over in order to break even, and in this example, have profit as well. So what we recommend that people do, they not only do it per week, is that if you're open 5 days a week or 6 days a week, you then divide that figure by that number, and that gives you daily break-even sales. And you can really be exciting with it and decide to divide that by, if you're open 8 hours a day, by 8 hours, and see on average how much sales do you need to be making every hour in order to reach the targets that you've set out. So they're the kind of figures you really need to know. You don't need to know this in relation to paying taxes. So your accountant won't be necessarily pushing you, and it's not necessarily their remit to do this, that you understand your break even and that you use it as a management tool. Their job principally, every accountant is a bit different, but their job principally is to make sure that you comply with the laws of the land in relation to paying taxes. So it's your responsibility as the business owner or leader to make sure that you know these figures so that you can manage your business really well. So we say that profit is theory, but cash is fact. And I get this so many from businesses that say, Helen, I got my accounts from the accountant and they told me I made 70,000 euro last year in profit, but my bank account is empty. I don't know where it is, you know, and they can't figure it out. And that's because cash is fact. The money has been gobbled up in expenses as they went along, or that they paid themselves or invested in something, but it's not that it didn't happen. It did happen, but they weren't keeping an eye on the cash and where everything was going as they were going along, so they didn't feel the benefit of that extra profit. So we say cash is fact. When and what expenses are going in and out of your business is what's really important in relation to cash flow. And I'm going to show you an example of that in a minute. But it's in relation to COVID, we need to be careful now, because we need to realize that there are other expenses going out of the business that you might need to take account of. So for example, you know, if you have team who are on the wage subsidy scheme, so you need to be calculating in when they won't be on that anymore. And you need to be really, I was talking to accountants recently on this, you need to be really, really careful on this. If you have team members on the wage subsidy scheme, and if they work even 1 hour extra, that brings their current wage entitlement, let's call it, to even 1 hour greater than what it was on average in January and February, then they're not entitled to the wage subsidy scheme anymore. So be really, really careful, because some businesses are being cut out with that. So you might need to be a little bit creative with the finances to make that work out, but just be very careful that you're not claiming the wage subsidies scheme in situations where a team member, even if it's only for 1 week, go over their average of what they were earning in January and February, because the grant is very clear on those stipulations. It has to comply with certain rules. So if you took out any extra bank loans, if you got any pauses in rents and rates, and like for some people, they got a break and they don't have to pay it back. For others, they do have to pay it back. So you need to work those into your cash flow. Be aware of possible extras there. Your VAT and tax is another example. I had a friend of mine, I remember saying to me during the summer, isn't it great now that the businesses don't have to pay taxes due to COVID? And all I could do was laugh, because that is not the case. We still have to pay our taxes, and we still have to pay VAT. But what they're saying is that we can have breathing space with it, and that we won't be penalised for not paying the full amount on the normal due dates. So be really careful when you're working out your cash flow. So for example, if you had VAT due at the end of May, and then if you VAT due again at the end of August, what the government were saying was that you didn't have to pay your VAT at the end of May. We've been given leeway up to next year in relation to paying that, but we still do have to pay it back. So that means, for example, if you decided you wanted to be up to date with all your VAT by the end of the year, that means that come the last, let's say, quarter, or from August on, that you would not only be paying VAT incurred between now and then, but you'd also be paying VAT that was incurred at the beginning of the year. So just watch out for that as well. That needs to be calculated into your cash flow if that's what you're doing. So other expenses that you may not have normally had before, obviously, would be PPE, health and safety audits, insurance maybe in relation to written document to work safety, social distancing expenses in relation to having greater space, maybe extra stock, whatever it is, to watch out for those. So we say there's two keys to money mastery: budgeting and reporting. And that you need to control your resources, your financial resources, by having these documents available to you. So having budgeting, having cash flow, have your P&L, and adjust it to set your budget. As I said earlier, cash flow for me is the most important of all of those documents. So when you're doing your cash flow, it's really looking at what money comes into the business, what money goes out of the business. And again, here are some examples. So the main cash sources would be generated by sales. It could be borrowed cash. It could be cash that's introduced into the business through sale of an asset. It could be a cash injection. And we would have seen this an awful lot in the last recession, where business owners took personal money, or they borrowed from friends or whoever it was, and had put a cash injection into the business. It could be that you got the business continuity voucher, or some other things, or some other grants. So that would be another area here, or obviously the wage subsidy scheme as well. So when you look at your main cash uses, then would be your general expenses, purchases of fixed assets, the purchase of fixed assets, the purchase of stock, loan repayments, owner's drawings. The owner drawings really would be more for sole traders. If you're a limited company, then your salary would be in with general expenses. So it depends on the format of your business there. So also when you're doing your cash flow forecast, look out for the things you would do. If you're doing a weekly forecast, you enter the first week ending date. If you're doing it monthly, it's the first month that will go in. You need to know your opening bank balance for the period that you're doing your cash flow for. So if you were doing your cash flow from July 2020 to June 2021, then you would go to your bank statement and see, well, as of the 30th of June, what was in the bank, and that's your starting cash balance then for July 2021. I'll show you an example in a minute, this will be clearer, but you can use these sheets as a checklist when you're doing up your cash flow to see have you taken these into account. So you can enter your credit limit if you use a credit line, a line of credit or overdraft. You can put in your cash in sheet. You can enter the source of the cash. So you might want to put in the client name or the particular outlet, or if you've different divisions in your business. So for example, I'd have a client that they do fire safety training, and they also sell PPE. So they would have two different, they divide their income in the business into the different areas. And I would highly recommend that you do that so that you can see where your cash is coming from. You have it just gives you more information that you can make better decisions in the business. So enter the amount into the appropriate week ending. And then for the cash out, enter the creditors, which are your suppliers, and enter the amount into the appropriate week ending. And then some things to consider. So you may need to make a rough guess to the amount that will be coming in and going out. And this is where people really struggle with cash flow, because they say, well, Helen, I don't know what sales I'm going to have in that month, or I don't know what my expenses are going to be. doing a cash flow forecast is just like anything else in business or indeed in life. The more you do it and the more effort you put into it, the better you will get at it. And we have an action coach, a formula that we call dream, goal, learn, plan, act. And you know, your dream is, well, where do you want your finances to be ultimately? What profit do you want to have coming from your business ultimately? And what salary will you be on at that point in time? So that's your dream. That's your ideal of how things would be at the end. So you might say, well, if that's where I want to be ultimately, let's say in 5 years or 10 years or whenever it is, then you might say, well, what's my goal for the rest of this year? What do I need to achieve this year in order to get me a step closer to that dream? So that's your dream and your goal. And then we say you need to learn. So I'm speaking to the converted here because you're on this webinar. So you're looking to upskill and to get remotivated maybe or refocused on what you need to do in relation to your cash in your business. So it's really good that you're doing that. There's loads of books available. There's loads of YouTube clips. There's loads of sample templates. So do as much learning as you can to upskill in this area. And remember that by practicing, we learn a huge amount as well. Then you can put a plan in place once you've done the learning. Of what you need to do, and then you take the correct action, and that's how you get the best results. So as I say, practice with this. Don't be disheartened because you feel it. Just start with 1 month, get the figures in for 1 month, and then see how you do with the second and the third, and so on. So as you receive a payment or an invoice, or as you get any extra information, then you change your cash flow forecast accordingly. So you may want to move out cash amounts from week to week to achieve positive cash flow. So for example, if you were seeing that, oh, I'm going to have a negative cash flow in August, but I know I'm going to have a positive cash flow in September, then what you might want to do is pick up the phone and ring a couple of suppliers and say, look, I know X, Y, and Z invoice are due in August. You know, can I ask you in this instance, can we have an extra 7 days on that? And we'll get our account fully up to date by the end of September. And look, people are very reasonable if you contact them in advance and they know you have a plan and they know that you are going to pay them. Or it might be that you were hoping to invest in, it could be a new marketing campaign, or it might be a new IT system. And you might say, well, look, I shouldn't do that in August because the cash flow isn't there yet. I'll push that out by 4 weeks and I'll do it in September instead, so that you're not putting the business under undue pressure. But when you have a cash flow statement, you can do that. You can make decisions well in advance, make the phone calls well in advance, and you won't be surprised by what's happening. Way too often, people look at the bank account and they think, oh, sure, I'm loaded, there's loads of money there, I can do X, Y, and Z. But they forget about the VAT returns, and they forget about maybe the salary going out, or the extra staff that were taken on for the busy period, that it's going to be more than normal, or that a lot of stock was brought in for the winter, and that the first invoices for those are going to have to be paid. So you really need to make your financial decisions based on having all of the information, not just 1 or 2 bits. And that's where the cash flow statement comes in really, really handy. And make sure then that at the end of each month that you're balancing, or if you're doing it weekly, that, and again, you know, technology is fantastic. Now, most of you will have banking online, and you'll be able to see at the end of every day, let alone the end of every week or every month, you know, where you're at in your with your business in relation to the cash balances. So make sure you update it on the cash flow forecast when you're doing that. So the next thing to understand is to know your cash gap. Now that's really saying the difference between when money is going out and it's coming in. But before I go on to cash gap, I'm just going to stop the share for a minute. I'm going to ask people, if you have any questions about what we've done so far, please pop it into the chat box and I'll go through it now. And in the meantime, I'm going to just flash up a quick example of a cash flow statement so you can see what I've been talking about. So as I say, please feel free now to pop in any questions you have into the chat box. So I'm going to show you this Action Coach example here. So you can see with this cash flow forecast, your cash flow, that's one of the main differences between cash flow and budget. Your cash flow includes VAT, because it's literally how much money is going into the business and coming out of the business. Of course, you need to account for VAT payments as going out, but when you're counting your sales, you have the VAT amount calculated as well in there someplace, because it does actually get lodged into the account, and it needs to be there then to be taken out to pay the VAT when it's due. So you can see here that this is done from January to December. Obviously, you can start it at any point in time in the year, but in this example, we've started in January. So the actual sales, the other income, the VAT on the sales above, or you might have it included if you want to have just one figure, but it is good to have it separate, because it's easier then to calculate what VAT is due if you have it separate. Then you have the cost of sales. So it could be materials, if you've outsourced any of the work, it could be wages and any other cost of sales. And that gives you then your gross profit. So it works that out for you, and it automatically calculates it as a percentage in this example here. And then you have your other overheads, or your overheads, or your fixed costs, as I would have been referring to them earlier. And there you have your accounting, any conferences you go to, entertainment, and your salaries, insurance, advertising. But again, you would just adjust these to whatever's relevant for your business. And if you can't think of what's relevant, literally just go through your bank statements. You'll see everything that's come out over the last while. They're the types of headings that you need to have for your overheads. And you can see down here then that we have the cash from operations. So that's the money in versus out, and then it also takes into account different taxes. But again, all of this can be adjusted to what's relevant for your business. This is just an example. And actually, I checked quickly to see there is actually an example in Excel. So any of you who are working with Excel, you'll see templates there. If you have a financial package, it will probably generate cash flow for you. So if you have if you're using Xero, for example, or Sage, or whatever accounting package you might be using, it might come up with one for you. But what I would say is the automatically generated ones, you will need to adjust it, because it should be based on your knowledge of the business, of when invoices are due, when they'll be due to be paid. Please don't rely on a computer generated one. That's fine as a template, but then adjust accordingly for your own business. So I'm just looking at some of the questions here. What would you recommend as an accounting package? Okay. So again, look, it does kind of depend on the business, and I most certainly wouldn't say that I'm an expert in this area, but what I would say is that a lot of people are using Xero and are very, very, very happy with it. My brain is racking. I'm trying to think of the other one. It's a Kerry-based business. A lot of clients are on it. The name's escaping me for the minute, but it's the Helens. If anybody can think of the name of their software, if you can put it up, that would be great. Can I suggest a good retail point of sale system? There is so many out there. It really depends on your business. Unfortunately, I couldn't say straight off any particular one, so apologies for that, but thanks for the question. And please don't think that only I can answer the questions. So we have 11 wonderful brains on here as well. If anybody else can answer that question about a point of sale system, and please feel free to pop it in there. So thanks very much for those questions, and please keep them coming, and I'll come back to them again later. Okay. So I'm going to just go back to the presentation there again. Okay. So knowing your cash gap, part of the reason of having a cash flow is that you'll be able to predict cash gaps in advance. So what a cash gap is the difference between, for example, when you need to pay for, it'll normally be a product, not always, but I'll just use a product as an example. When you have, let's say, bought stock and you have to pay your supplier, but you may have bought stock, let's say, for 3 or 6 months to do you for 3 or 6 months, because it might be cheaper to buy in bulk, for example. That might be the reason. That there can be many, but that might be the reason you do it. And yet your supplier might only be giving you 30 days or 60 days notice to pay, but it might take you a full 6 months before you get paid by your customers. from selling all of that. So then you have a cash gap there. I'll show you a graph that explains it maybe a little bit better in a minute, but that's what the gap is. And the key is to have it, to keep it as positive as possible. The key components, the key things you need to remember, and I've deliberately put in different terminologies here. A lot of time people shy away from finance, and I think it can be quite confusing that there's so much different terminology used. So your payables are your creditors, it's what you owe. Your receivables are your debtors, it's who owes you. Your inventory is it's more of an American term, but if you're downloading samples of any of this online, you might come across different terminology. Really, it's what we would call stock. Sort My Books, thank you so much. That Sort My Books is the accounting package that I was trying to think of, and I have a good few clients using that as well, and they're really happy with it. It's mobile friendly, it's in the cloud. It's great for getting instant reporting, up to date. Obviously, with any of these packages, the better the information you put in, the better the result you'll get back. But Sort My Books is excellent, and the help and advice around it is excellent as well. If you have any issues or problems with anything, they talk you through it. So thanks for that, Helen. So okay, so here's just a graph of what the cashback, basically a diagram of what I was saying there. So if you get stock in over this period of time here, but you have to pay your suppliers within 30 days, but you only start selling here and you don't, so that's your receivable when you get the money in, but you don't get all the money in up to here, then your cash gap is this difference here between when you have money, all the money paid out, to when all your money comes in to pay for it. So it's really important that you're keeping an eye on your cash flow, so that that you don't run into a difficulty. A lot of businesses go down because of cash flow. Like over the span of the year, they might be profitable, but if for a 2-month period you can't afford to pay salaries, then your business is going to be in serious trouble. And it doesn't matter that the money was all going to come in, in the third quarter, you weren't able to get through the second quarter. So it's really important that we keep an eye on that cash gap. And the best way to do that is to have a really good cash flow statement, because you're ahead of the curve, you're ahead of anything happening, you see it before it happens, and you can make changes accordingly. So there's 3 main ways in order to reduce that cash gap. One is to increase the payable period. So for example, if your supplier is saying, well, you need to pay me after 30 days, then you might say, well, look, can we extend that to 60 or even 45? It doesn't have to be a 30 to 60, you can look for maybe something in between. Or it might be that you pay a certain amount after 30 days and then the rest after 60 days. But don't be frightened to negotiate. An awful lot of payment terms, I'm sure a lot of you have seen this, have come across it yourself in the last couple of months, have changed. A lot of suppliers now are looking for cash up front, or at least cash on delivery, and are looking for much quicker. If there are debtors days, they're only allowing maybe 7 to 14 debtors days. So what you want to do is you want to increase the amount of period of time you're getting from your supplier to pay your bills, but you want to shorten the amount of time that your customers get to pay your bills, and that's how you narrow the cash gap. And the other way is to speed up your stock turn ratio, so how quickly your stock is turning. But again, it depends on the business you're in. It might be a case that it's difficult to reduce the amount you buy at any particular point in time because you're getting a better price due to it being in bulk. So if that's the case, you might look to reaching out to others in your industry, in your area. If you're importing stuff and if you find it difficult to talk to what may be considered competitors in your immediate geographical area, there might be people in Cork or Limerick or Dublin or Galway or someplace else who are also importing from the same country and will be interested in getting containers, and they're not actually in competition with you, but you might be able to work out, have a buying group that would work in that way. So it really is a time to be thinking outside the box if you're suffering a cash gap there, and to be thinking what can you be doing to narrow it. So tradition and the nature of the business often set the typical cash gap in a given industry, and some industries have inherently higher cash gaps than others. But on saying that, we are in unprecedented times now, and whatever was a given 6 months ago or even 4 months ago, you can forget about. Everything is up for renegotiation, so don't be frightened to pick up the phone and talk to your suppliers or your customers and see what you can do differently, if you need to. So what are the key performance indicators in relation to the finances of your business? What are your business vital signs? Well, the main ones obviously are what is the revenue? Are sales increasing? Are they decreasing? What's happening with them? What are the profits? What money am I making? Now, I spoke about profits on this so far. I only spoke about the business profits, or even the business margins. You really need to know what money you're making per product or service that you're providing. Okay, because I've come across it way too often in business where they're making a good profit in one area of the business, and they're working really, really hard to be able to do that. And then another area of the business might actually be losing them money, and they're treading water and they can't figure out why the business isn't doing better. Because they can see the success in one, but they don't realize that the other area is dragging it down and is gobbling up all the benefits of those extra profits. So they're not seeing it at the end of the day at all. So and this is really important for your marketing. When you're marketing and promoting products and services, which are the ones that are making you the most money? Which are the ones you should be pushing? Sometimes people push products and services that are actually nearly losing them money, and there's a huge opportunity cost there as well, of course, as well. So it's really important to know the profits of the overall business, but also per, as I said, per product and service as well. And projected cash flow. If you haven't a cash flow already done, please make it a priority after today that you do a cash flow statement so that you know where you stand. And the equity of the business, is your business gaining or losing value? The ratios in your business. So what are the important ratios for your business? So for some businesses, it's they need to know the rent to sales ratio, or it might be the wages to sales ratio. So what are the important ratios for your business, and do you know all of them? Obviously there'll be a lot of non-financial ones as well. So the key activity measures or drivers in relation to operations or delivery or whatever it is, and customer service measures. So are there more or less complaints? Are you able to, how long does it take to respond to queries, or whether it's a sales query or whether it's a customer service issue, whatever it is. So I suppose be aware. I suppose the finance in the business, numbers in the business aren't only in relation to finance, they're also in relation to running your business. There's a great guy called Keith Cunningham. He's a financial guru. If any of you have read Rich Dad, Poor Dad, written by Robert Kiyosaki was mentored by Keith Cunningham, and I've had the pleasure of being trained by him over the years a couple of times. And Keith Cunningham says numbers are the language of business. And he said, look, you'd have no business in doing business in China without speaking Mandarin or whatever the local language is in whatever part of China you're in. And he said, likewise, you've no business doing business if you don't understand numbers. You do not have to be an accountant. You do not have to love numbers. You do not have to be able to work out the profit and loss yourself, or even the break even or any of that. But you do need to know what they are. You do need to be able to read the reports, and you do need to know what decisions you should be making in your business based on those figures going up or down. And it is something that, please trust me, absolutely everybody can learn. There is nobody who cannot learn to know what they need to know in relation to numbers and running their business. You just make sure it's not about pace, it's about direction. Once you're improving and getting a little bit better, and I'm sure wherever you're at now, you're much better than you were maybe last year or 5 years ago or whatever. So hang on to that and keep building on it, and you'll get to where you need to be. So, so what is your profit margin? So just to I want to really emphasize this bit. During the last recession, you'll all have seen this, presuming you're around long enough, and you'll have seen that many businesses started slashing prices and started discounting. And we actually trained our customers to look for discounts and to only buy when there are discounts, especially in the retail sector, across the board, but especially in the retail sector. To the extent that even myself, I'll walk by a shop that is 20% off and I won't look twice, it'll barely register with me. It needs to be 50 or 70% before it'll even register. Oh God, there's actually a good sale on there. We have been trained to value really large discounts, but that's absolutely crippling businesses, and we need to be sure that we don't do the same thing this time around, that we don't reduce prices without knowing exactly what's happening in our business. So that's why I wanted to show you this example here. This is the true cost of discounting. So if we're going to take an example, let's say you have, again, I just use a product because we all consume products. So even if your business is a service business, you'll still be able to relate to this because we're all consumers as well as business leaders. So let's say in this example, there's a product that has a 30% margin. Now, this is the gross margin I'm talking about. So this is the money that needs to come into the business to pay for the fixed costs, which are the wages, the salaries, the rents, the rates, the marketing, the accounting, the coaching, the training, all the stuff that's done in the business. So that's what that 30% is for. So let's say we decide we're going to have a sale. We're a little bit nervous about where the economy has been. We feel we need to get rid of maybe some stock or whatever it is. And we decide we're going to have, we just go with a modest 10% discount. Now, what this graph is telling us is that at a 30% gross margin, if we discount by 10%, we would need to increase sales in the business by 50% in order to be making the same money. A massive 50%. Now that's a little bit scary, and often people don't believe me in this. And I have coached accountants and financial controllers and lots of different people on this, and they have found that figure really difficult to agree with, I suppose, really. So I'm going to show you a quick example. I'm going to stop the share here, and I'm going to reshare with a whiteboard, and I'm going to do an example for you on this. So we're going to use text. So let's say we have a jumper and we're retailing it for €100. So that's the price to the customer when they come into the shop. In this hypothetical example, there's no VAT. So just for ease of showing the example. So let's say I'm the owner of this boutique, and let's say I bought the jumper for €70. Okay, so my gross margin then is €30. So this is the same as the example I showed you earlier. There's a 30% gross margin. Okay, and that's why I picked €100, because it works out nicely for our percentages. So coincidentally, 30% is also €30 because I used €100 as the example. And let's just say we sell, this €30, let's say we sell 100 units. Okay, so I did that wrong. So if we sell 100 units, then that actually gives us €3,000. If we multiply that out, €3,000 to pay our bills. Okay, so that's again is to pay the salaries, the rents, the rates, the whatever. So do you remember I said earlier, if we have a 10% discount, so what am I retailing my jumper at now if I have a 10% discount? Okay, so it's not a trick question. It'll be €90. But how much do I have to pay my supplier for the jumper? Well, I still have to pay them €70, don't I? Okay, so what does that leave me for my gross margin? My gross margin is now only €20. Okay, and that's what people don't realize. A 10% discount, in this example, using these figures, a 10% discount, the full whack of the 10% comes off the gross margin part. Doesn't come off the variable cost, the variable cost, the cost of goods sold. I still have to pay my supplier the same amount. So the 100% of the discount comes off this portion of what's made up of your retail price. So now now we have 20 euro, and if we still only sell 100 units, that gives us 2,000 euro. Okay, we had 3,000 euro above. So if we want to get 3,000 euro, if we want the same money, we actually need to sell 150 units. That's our 50% extra. And that is what will give us our 3,000 to pay all our bills. Okay, that's what people don't realize. If they discount in this example by 10%, they need to bring in 50% more in order to still bring in the same money to pay the bills. Okay, so I'm just going to stop that share now, and before people get too depressed, I'm going to show you the impact of increasing your prices. Okay, so if we'll use the same example, if you have a gross margin of 30% and you decide to increase your costs by 10%, you would actually need to lose 25% of your custom, 25% of your business before it would impact on your amount of money that you've left to pay your bills and what you were making previously. So again, I just do an example, and again, pop in questions as you want there. So for that, okay. So now I'm going to say, I'm just going to move this up here. So now we have the same example. We have our 70 euro plus 30, and we're retailing it at, I just leave out the euro sign this time, you know it's euro. We're retailing at 100 euro. But now we decide that we're actually going to increase our price to 110. I'm still paying my supplier 70, but I now have 40 euro left over as a gross margin. So if I still sell 100 units, I now have 4,000 euro to pay my bills. So here it was 3,000, but I now have 4,000 because of my 10% increase here. So even if I only sold 30 units, I would still have my 3,000 to pay my bills. Okay, so even if my sales reduced, I would, sorry, that should be 75, sorry, that should be 40 because that should be 75 and this still works out. But this is 40, so I still have my gross margin of 40, even if I only sell 75 units, so that's a 25% decrease from the 100 units. Even if I only sell 75 units, I still make my 3,000 to pay my bills. Okay, so I hope that made that other example clear there.